So now that we've considered the potential challenges or some of the summary challenges that we expect in the next quarter, if you turn to page 5, we highlight some of the themes that we expect to play in the next quarter or two. The first point is alternatives to nuclear power, something which we've been implementing since the nuclear crisis happened, and we think that is a theme which will yield to potential alpha opportunities over the next quarter or two. The second point is agri-inflation, and I had the privilege of listening to a presentation from Adam Fleming of the Fleming Family Office recently when he presented a slide showing the price of grain going back to 1600, which basically showed prices of grain as far as the recorded history goes. And it shows that over the last 30-40 years we've been in this very fortunate period where basic food staples have been at absolute rock bottom. This is clearly unsustainable as we are reaching the end of our kind of productivity gains in agricultural arena. There may yet be a new technology or new improvements here, but it does look like the growth in population, and as 80% of the world population eats more and eats better, it is going to place more and more pricing pressure on agricultural goods, and we think that is something which one needs to consider when constructing a portfolio. We have, to a degree, looked at this before by looking at companies such as Yara, which is big in fertilizers, and other groups out there. But I think it's not just those who are producers of agriculture. You also need to look at logistical groups such as Olam, Noble, and others out there who may stand to benefit from this. This leads us on to the next point on the potential themes, which is the endogenous demand within Asia. As the consumer market grows and the market becomes deeper, this endogenous demand will continue to fuel intra-Asian trade. And again, the suppliers and logistical groups who are primed to play a role in this trade will benefit, and we're looking at those who will be the emerging winners because of their dominance in the market share, because of their existing networks, and we think their credit risk will come lower, and we will see more capitalizations from these groups. So we hope to capitalize on that. Fourth on the list here is the impact of the new regulatory changes. Again, it's something which has been part of our brainstorming discussion within the advisory board, and there's no better example than Solvency II, where our evidence and our work suggests to us that the number of insurance groups across Europe are being persuaded by the regulators to buy government debt. Now, part of the reasoning is that the governments need to sell these bonds to someone, and they may have found the next buyer of these bonds in the form of insurance groups. So if you look at the Solvency II calibrations, they seem to be very favorable towards government bonds. They seem to be less penal towards AAA rated corporate bonds, but if you go below AAA rated corporate bonds, there's an exponential rise in capital charges, and for equities there is a significant rise in capital charges. So it does seem to us that this will lead to a marginal bid for higher rated bonds, which then you have to offset against the interest rate, a cycle of rising rates. But we think there will be opportunities here to get ahead of the market and take advantage of certain situations before they actually emerge. Fifth point here is the prospects of a successful soft landing in China and the increasing depth of its capital markets. Now, we made a mention in our annual outlook that we feel that the Chinese authorities will be inclined to accelerate the tightening early on in the year, early on in 2011, so that they have plenty of time left before the handover in 2012-2013, the leadership handover. In case they've tightened too much and the economy is slowing, then they can refuel the economy. So we think that thesis or the forecast we made seems to be coming through, and there is a possibility of China achieving a soft landing. If that was to happen in combination with the increasing depth of its capital market, then we feel that there will be a number of securities that look very attractive. We are still not heavily invested in the space. We continue to monitor this as we have been monitoring for the last 14 months. but we think we might be able to find some dislocated opportunities here. This ties into my next point about the higher volumes of capital issuance from our Asian financial institutions and the deepening market and new capital instruments such as COCOs. We think both of these are tied in. We think the Basel III rules become clearer as you start to see more consensus emerge on the new instruments of capital, we think that the Asian financial institutions may actually become the leaders in this space, simply because the first institutions to come out of the market will be those which are better capitalized, which have less reliance on wholesale funding, and which are deemed to be less risky by investors. And while you only have a handful of European banking institutions that would fit that bill, there is, in our view, at least a dozen odd institutions in Asia that could issue such an instrument in the near future. So we think as soon as we get a bit more clarity and the Asian regulators start to buy into the whole Basel III rules and the new instruments, you start to see a lot more issuance from the space. And we do believe that the early investors and the early adopters of these instruments will benefit from much more alpha, because there will be some risk premium, initial risk premium that you associate with any new product that one could benefit from. So we think that could be one major theme to play over the next few quarters. And just moving on from page 5 to page 6 is just an extension of the themes to play, which is our view that the financial space remains dislocated and it continues to offer compelling opportunities. Clearly, the spreads for financials have ratcheted tighter since the Lehman bankruptcy. Nevertheless, they are nowhere near their pre-crisis level, and they are meaningfully wider from that level. And that's just at the index level. At the individual security level and the individual issuer level, the opportunities are even more pronounced. And for that reason, we continue to favor a heavy bias towards financials. We do think that we will see increasing opportunities in Asia, and we are rotating some of our capital towards the US as well. But on the whole, the financial space, we think, will remain one of the most interesting space. It's also noteworthy that when you enter a rate hiking cycle, it tends to be quite beneficial for the life insurance groups, as low rate cycles leave the life insurance groups at a risk of their payments being above the guaranteed, the earnings being below the guaranteed payment rates that they have made to their policyholders. So life insurance companies tend to benefit from this cycle. So we think the insurance groups could be in a better position. On the other hand, in a hiking or in a rising rate cycle, the banking groups tend to be net not as much of a beneficiary, they tend to be neutral. But all in all, we think financial space continues to offer a very compelling opportunity. And on the other side of the coin, if you turn to page 7, which asset class do we feel is going to be the most vulnerable? Now, this does not mean that we will not play in this asset class at all. In any event, we don't tend to invest in deeply subordinated high-yield securities, but if an opportunity does arise and our research and our evaluation suggests that there's plenty of rewards, then we would look at it. But by and large, we think the high-yield space is now approaching levels which is consistent with the valuations looking expensive. On this page, I've shown a slide taken from Deutsche Bank where they have looked at default spread premium for high-yield bonds. They've assumed a recovery of 40%, which I suppose could be considered to be a bit generous for especially the CCC rated institutions. So if anything, this may not show how expensive the CCC rated bonds have become. But if you look on this basis and you look at the excess spread available, once you've accounted for the average default risk, then I would say that the CCC space in particular looks very expensive now. And maybe double B looks okay-ish at this level. Our own preference is to focus on single A to BBB spectrum of the rating ladder. But obviously that's on a case-by-case basis, dependent on our bottom-up research. So that's a very brief presentation on our outlook for the next few quarters. I hope this gives you a good flavor for how our portfolio is structured, and we look forward to keep you updated on our progress as we move forward. I'll open the call for any questions if there are any questions to be.
Presentation mode is now disabled.
Okay.
Hi, Zam. A question this is predictor here from AXA. It's a bit curious about your tail hedges and how you kind of try and build some complexity in your hedging process. And how you mentioned you took profit on some too early, and how you're going to, what your approach will be for the second quarter.
Thanks for the question, Pradeep. I think it's a very valid question. I would say we try and keep it simple. What we try and do is to buy these put options or these warrants, which are essentially a form of option where we pay the premium up front and buy these out of the money or sufficiently out of the money where they are cheap enough. And if there was a systemic contagion or if risk assets undergo a significant fall to say 5% or more, then they hike upwards and give us an exponential return. So that's where the convexity comes from. The issue with such options is that there is quite a big drag on P&L, and it is something that we have factored in. So for example...
But would you consider a kind of put spread form of strategy where you're limiting the overall cost rather than buying outright put option?
It is something that we continue to do work on. The only thing for us would be anything we do, we want to make sure that our downside, especially on the hedges, is clearly outlined. So we need to be very confident that our potential losses in the worst case scenario on these hedges would be no more than the premium we have paid up front. So yes, it's something which we are doing work on, and I think hopefully we'll be able to deploy more of that as we go forward. So that's kind of how we are on the hedges right now. In terms of where we think we might have taken profits early, I think with the fractal hedges, the timing is always an issue. What we try and do, and that same thing goes with our long investments, we try and scale in and scale out. Sometimes we get it wrong, sometimes we get it right, but we will look, well, we're trying to optimize this more and more, so our scaling in and scaling out is as efficient as possible, and again, we'll continue to do work on that. Does that answer your question, or?
It does, thanks.
Thank you, Prodi. Okay, looks like there are no questions, so if anyone has any follow-up questions, please feel free to send an email or contact us directly, and we'll endeavor to get back to you. And thank you everyone for dialing in.